And the next panel, it's my guarantee. Those of you who are staying, please stay back. So this panel is moderated by Thiagarajan and Asheesh Chandra, the founder and CEO of Kristal. He is the speaker. He was a trader, and it's nothing but trading. But it was so interesting because this is a recorded thing. So I guarantee that stay back another 35-40 minutes. It's value for money. Thiagarajan is, you all know, he is now presently chairman of SYFX Treasury Foundation. He is known in the forex markets as Thiagu. He started his career in Syndicate Bank. Then he moved to Reliance, and he was a super trader. And now he is I can say, super teacher or super commentator. And with this, I will like to play this.
Thanks for the introduction. Ladies and gentlemen, it gives me immense pleasure to interact with Asheesh in this fireside chat. Thanks, Almas, for the opportunity. The primary theme of the conference is Future of Finance. The secondary themes are adjusting, adopting, and innovating. Over the years, all of us have adjusted, adopted, and innovated in keeping with the emergence of modern trading technologies. Now, at the start of the decade, the question is not what if, it is what next. We would use this interaction to understand what future holds for trading and to what extent we should adjust, adopt, and innovate in future. Asheesh, actually, 20 years back, when the trading started, actually, when the Reuters introduced the trading matchmaking platform in Indian markets, we all thought it was too sophisticated and too expensive for the markets. And then we never thought it would last the distance. But fortunately, after 20 years, we have adjusted to that technology and adopted. And there have been so many single bank platforms as well as multi-bank platforms which have emerged. The price delivery is happening at your desktop seamlessly. What is your take on the future of digital platforms or delivery channels?
Thanks a lot, Thiago sir. So it's good to be here. Thanks to Team Almas also. So digital platforms, Reuters and Bloomberg, of course, in these multi-dealer or single-dealer platforms were the pioneers as they came on almost 2 decades or more ago. And as we've seen the world evolve, there are new asset classes being created. There are new ways of trading being created, whether it's completely computer-led programs, making markets or doing execution. But there's a lot of innovation happening across various segments. So the future is quite clear that technology adoption is increasing. Anything that can be automated is being automated, and the simple task of, let's say, executing transactions is definitely going more and more to machines. And we also know of the big hedge funds or the players who operate in those dark pools. They are coming and helping provide liquidity to more and more to these programs. And the banks or market makers are also using these a lot more. So clearly, it's driven by technology. Within technologies, whether you have people going into X technology or Y, or whether it's going to be AI driven or ML driven or just high frequency kind of stuff, that I think remains to be seen. I think there's a place for pretty much everything to find their niche. But clearly, multi-dealer platforms, trading on cloud-based systems, so moving away from desktops. Those are the trends that are definitely have established their norm and are going to go in that direction. In fact, one point I would like to say also is that with cryptocurrency coming to play, now you have a lot of brokers, or let's call it, these are aggregators of liquidity, who are able to open APIs, and you can pretty much start a brokerage in a box in a plug and play manner. And that is how trading is innovating into. So it's going to be a fascinating place to see how different asset classes adopted. Forex being one of the first ones, equities, of course, being there. Then you also have cryptos coming in. Bonds, if you see, is actually still lagging a bit behind. but it totally depends on how each asset class embraces it. But technology is coming, and slowly it's changing how each asset class is being traded.
Thank you, Asheesh. Actually, there is a saying, if you talk to a person regarding trading technology, you frustrate him for a day. If you teach him trading technologies, you frustrate him for a life. No, actually, the problem is with the buy side. Actually, as a person who has been there in the buy side for quite long, we always feel that there is of course, we always feel that the pressure is on margins. So at the end of it, actually, we always want to know how the sell side is executing my orders. The execution capability, that is what worries me a lot. Now, how do I choose a platform? And basically, when I say choosing the platform, how do I choose a platform in terms of execution capability?
So, I remember a time almost 20 years ago where there used to be a roster book, and a trader would have called, let's say we're talking dollar rupee forex rate, he would call 10 banks on either a Reuters system or whichever mechanism, and note down the rates at which different people are offering different sizes and so on, and based on that make a market. And it was very, I would say, paper plus computer driven, kind of a hybrid over there. Today, if you move forward, it's all an API call, a click here, and that click sends 20 clicks to 20 counterparties, and then whatever 50 machines give a price, and the whole thing comes back. So it's basically gone automation to that extent that on the sell side, you're basically just aggregating liquidity, and I don't think there's any bank platform that works as a single dealer anymore, at least in forex space. It's very, very rare that at least a big global bank works like that. So most of them have migrated to multi-dealer because most clients want access to that. Even the traders in a bank want access to an open kind of a platform where they are not forced to go to their own desk and go to the street to get the best liquidity. And most of these multi-dealer platforms which are there, they are able to choose the best pricing for that particular size. Everything happens within like a microsecond. So it's all automated to an extent that these liquidity providers or these softwares are pretty much in today's age, 20 years down, are commoditized in some sense. And you cannot even imagine a life where these things did not exist. And today you can sit in front of your screen and trade more than 100 currencies and different crosses, as well as when you talk about stocks, there are different exchanges where the linkages are for any broker. So it's all technology, the pipes that are created, which go in that direction. But of course, to build those pipes, you need to have agreements with various liquidity providers, and that's where I think once you set up that infrastructure, then technology just takes over and makes sure everything works quite smoothly.
As a sell side participant, you think a bid or spread and market liquidity factors are considered as part of the transaction cost?
Yeah, so effectively, for the buy side guy, bid offer as well as liquidity is what they have to bear, and sell side sees that as a transaction cost, so they pass it on. Now, as most of the trading books, they are more and more, or rather less and less incentivized to make any proprietary trading positions. So the only leeway they have is to guess or to gauge, where markets are moving, and try to make sure that the risk management is not losing money, but at least a bit more accretive to their let's say banks or trading houses. But as that happens, what they also realize is that there is not too much left for a human being to innovate, and if you do something, your clients may feel that you're doing something wrong, and hence automation, which brings transparency and best execution, is probably the only way. So if I'm a trader in a bank and I try to make money, the client may think that I'm making money off him, and that kind of becomes a conflict. So I may as well say that, what, just make it a system, make it transparent, give the best execution, and let's go with that, and charge a spread, charge whatever, and declare it, right? So whether it's a brokerage, whether it's bid offer, just make sure that it's transparent, it's visible, and the client knows where they're trading. And anyway, it's best execution because that's how the machines are kind of programmed. So yes, these are ways that you can actually charge to make sure your infrastructure costs are taken care of. But it has to go the automation way, because there is no point incentivizing a trader to even think outside the box and create more risk. Your job is to execute the best, so you go with that.
Actually, the serious concern on the buy side, actually, it has been about the market impact. When a large flow hits the market, actually the price moves rapidly. I don't want, actually, I want to send the flow through, but not disturbing the market. This has been the primary concern of the buy side corporates, actually.
Yeah.
So, what is the consistency of the execution performance of these platforms?
So what happens is that, so I wouldn't know whether how one bank does, and it's unfair for me to comment on that. But I think what I would say is that yes, there is a market impact element, especially when you're doing large sizes. Imagine a big private equity player coming and doing some hedging in forex, or if I take the recent example in the stock markets where I think SoftBank was seen to have traded a large amount of call options on certain stocks, and that started moving the volatility of the option, the delta, the gamma profile, and literally, it felt like it's an LTCM moment in the making someday, because when you have a big player coming from the private markets into the public markets and doing sizes which public markets are not used to, especially in some of the smaller names, or let's say mid cap companies, or even smaller ETFs. And that creates a lot of dislocation, which is where the prime brokers and the banks or even hedge funds, they come and there's a very well flourishing OTC market where you kind of agree on some kind of negotiated prices, and it's pretty much an OTC contract that you'll end up doing. So I've seen that in my experience, whenever you do a size beyond a certain amount, and depends on different equities is different, forex is different. You do land up using the OTC markets, going pretty much the old school way of phone calls and negotiating a rate, and this whole system-driven trading is kind of bypassed over there, because you don't want to almost scare all market participants by sending a large size orders in that manner. But one key thing is that even today now, a lot of brokers, a lot of market makers, they have these algorithms where you can actually release orders in small sizes. So even at our Kristal platform, we use certain brokers in our back end where the orders, there are various algorithms which are able to take orders in smaller sizes. And of course, you can have human traders who can release the orders as and when they feel it is appropriate in the market without dislocating it, because dislocation is not in the interest of anyone. Like everyone loses in such a scenario. So it's best to do it in a manner where the execution goes quite smooth. But I think it's a combination of man and machine in that case.
Does it give rise to the new phenomena, execution consulting?
Of course. So effectively, execution consulting, I think, is important as sizes start growing up. So like I said, different markets, there would be a different cutoff beyond which it's important. But yes, I think it's definitely a growing field, and as there are new markets being created in some sense. So imagine a company going for IPO, the private equity player looking to exit, the founders may be looking into liquidity or employees. How do they go about doing it? So that kind of stuff, I think it makes sense to have someone, either the investment banker or an independent execution consultant. So just so that you don't have these conflicts coming in, to make sure that people get the best price and the best way to go about it, making those matchmaking happen. It's almost like what, as when we started, we spoke about Reuters 20 years ago, the multi-dealer system or single dealer, but now it's more about execution consulting on, let's say, listed stock or even forex or options, whichever way you go.
Yeah. Of course, this is a pertinent question actually. Experience. It is attributed to Aristotle. What we repeatedly do, both as individuals but as well as group. Investors trust in experience, and this experience is the consequence of repeated and lengthy observation over a period of time. As technology replaces experience, whether the experience becomes obsolete or we going to become stale.
Yeah. No, I think and that's quite a futile statement. Experience cannot become obsolete, but the experience has to be, I think, deployed in a very different manner, and there are different learnings coming out of it, right? So, for example, the experience of forex trading in the 1990s, I think, is very relevant in crypto trading today, or let's say in a small cap stock trading in a market today. So basically that, and those rules. See, what is a machine? A machine or an algorithm is what the humans teach, what experience teaches them. So I'll give you an example. So at Kristal we have like an investment committee that designs the asset allocation algorithm. Now at the end of the day, there are tens of thousands of clients looking at the algorithm to see what it tells them on how they should go about doing asset allocation. But it's the experience of the 12 people in the investment committee that has designed the algo, and that is where the whole intelligence comes in. Technology only helps bring that intelligence to the table in a scalable manner, and that's I think is something quite important. But at the same time, whatever models you make, whatever systems you make, technology, Moore's law goes at such a fast pace that within 3 to 5 years, basically the previous technologies has become obsolete, and you need to go to the next one. We had never heard of dark pools and high frequency trading till, let's say, about 10, 12 years ago, when it started in the US, and then people started thinking about what FPGAs and whatnot to put it in the exchange, co-location, etc. We had never heard of multi-dealer systems coming in FX options, volatility trading, and now we're talking cryptocurrency, where we don't even know how the asset is custodized, where it is there, hot wallet, cold wallet, whatever you want to call it. And so many different parameters coming into it. But the simple experience, the ground rules, like they call it the Newton's law of trading, those don't change. The basics remain the same. The asset classes change, the liquidity changes, the systems change, the algorithms change. But the laws that you've learned from experience, they don't change. So ground rules are always the same.
Just an extension of that, actually. Automation is a more equalizer, actually. Without having any fundamental or technical knowledge, I can walk into any trading room and then start trading, actually. That is what is happening, actually. So to that extent, actually, do you think actually fundamental and technical knowledge is no more required?
I wouldn't say it's no more required, but I would say that the pendulum is moving in such a way that there was institutions who were pretty much the largest player in the markets. So at least you look at what has happened in the GameStop or AMC saga.
Yeah.
So there are hedge funds and institutions who are known to be that, okay, these are the people who know everything, they know it all, they are superhumans or whatever, and they have models, complex things, simulations, etc., going on, and they'll figure out what they're doing. And here's a group of like 10,000 people coming on a chat platform and just releasing memes, and they take down a hedge fund. So it's just a different era that we are living in. Now you may say that yes, is there any fundamentals to how the stock has moved? Probably not. So the whole theory of what fundamentals means, the whole theory of valuation, the whole theory of like MMT as it comes in, it's all being challenged. And the best way to think about it is that if you believe that look at NFTs, look at crypto. If you go by traditional valuation theory, you will just scratch your head and go crazy, like what the hell are we doing over here? but that's happening. So we're living in a different world. We know that markets can be crazier than you are. You can be liquid. So totally depends on what new world are we living in, and where does it take us? And yes, it is questioning. It's challenging the basic assumptions of valuation, the basic assumptions of fundamental stock picking, and quantitative money. The money on quantitative models is surpassing the money on let's call it fundamental models. That's definitely is happening. But at the same time, I think it's the same kind of argument of passive versus active investing. I think there is an era, there is a economic environment where one does better than the other. So it's good to have both these quant as well as fundamental as two factors in your models or in your analysis to make sure that you can deploy the right kind of ammunition at the right amount of time. But yes, the importance that quantitative models had, let's say, a decade ago versus what they have today, definitely has gone up. Is that right or wrong? I don't know. Only time will tell. But yeah, it's definitely changing the weightages and how different people are making money. In a weird way, if you see, you moved the power from institutions to people. Is that wrong? Not really. But the way it's being done, it is confusing.
Yeah, beyond the platforms, actually, we will start talking about the most important element of trading, that is forecasting. Actually, the forecasting has taken a leap, actually, in time series forecasting models, actually, which can tell you where the euro is heading, where the table is heading. Are they relevant in this context, or actually too much hype about it?
No, I think there is a relevance in terms of using forecasting models, but you cannot look at them as cast in stone. So I think all these forecasting models should be used more for a scenario analysis, identifying Six Sigma, thinking of what are the potential black swan events and running those simulations. So I think that's the best way to go about it. Whether you use an ARMA model or whether you use a neural net or a genetic algo, there's no right answer to it. Or an SVM machine, whichever way. So there'll be tons of zillions of models, frankly. I mean, I myself know of at least 20, 30 different models, which I have seen. None of them really give you the high conviction that one is better than the other. There is no clear verdict that human trading is better than, I mean, when you're doing the buy side at least, alpha generation, is human better than a machine? There's no real right answer. You've seen them outperforming each other or underperforming in various market scenarios. I think it is important because it's like a factor that you have to consider to make sure that you are aware of what could happen. Now, nobody forecasted COVID in March 2020 and how it could come up. And any model you take, it won't. You just won't. Nobody predicts such a thing to happen. So any model you take, it's based on historically what it has seen. So the whole quantitative field is actually based on history, right? It's trying to predict the future, but based on history, with this assumption that history repeats in some shape or form. If you look at the field of AI and ML, at the end of the day, yes, it is learning, it is doing some kind of relearning, reinforcement, or whichever model we may use, but it's still based on historical data. And which is where I would say that giving shocks to any model, taking it through black swan events or totally unforeseen events is something that is, I think, essential to do, especially if you are doing model-driven trading or you're making any model even to advise you on what you should be doing. But if you cannot, if you're taking a model and blindly going to follow it, it's a mistake. All models will break. The whole concept of AI or reinforcement learning is that models will break, and so you need to relearn, you need to reinforce as you learn. So only a model that is learning by itself, which is what a human brain is, actually is better than just a static model which is doing a formula based trade.
So continuing on the same lines, will the FX traders be replaced by robots?
So I think if you are looking at an FX trader who's making prices based on checking liquidity, then the speed at which algos behave or execute or gather market data and process that information, I think it's almost there in that direction, where if it's not done across various currencies, so for example, G10 currencies are pretty much run by machines now. Because I don't think but yes, you need a team or a human to have oversight on those machines. But at the execution level, you don't really need people to do that because it's more inefficient. In fact, they'll have a very highly stressful life if that's what they're doing and let machines handle it. But if you don't have oversight on those machines, then you have the blow-ups like when Swiss franc movement happened. any depegging happens or any big move goes. So it's very important to have some kind of hybrid model. I would say like a 90-10, where 90% is automated and 10% is like the boss of the machine.
So what do you think the trading room of the future will be look like?
I think the trading of future is going to a different, there's a different domain of execution coming in, where you have voice-based commands or you have natural language processing coming in, where as people on the buy side try and give orders, you really want to parse those orders in an automated manner to make it scalable. So some of the latest technologies are trying to get multi-dealer across various other asset classes. So let's say Forex is a multi-dealer, equities are multi-dealer in some sense because there are multiple exchanges, but options are not, let's say volatility in Forex world, or even structured products. They are going more and more automated. And the other aspect is the client interface. So now a client can actually, there are technologies coming up where either on voice or by writing the text, you can actually give an order, or not even give an order, you can actually just brainstorm a transaction, and the machine will tell you what the machine thinks or what other people are doing based on whatever is permitted. So for example, you could go and say that, I want to know a dollar yen 110 put, like if I want to buy a put, does that make sense? What is the iterations? So I don't need to sit and press 20-30 buttons anymore. I can just say, okay, price me a put at 110. What do you think is 111 better, 109? So literally machine becoming your advisor, almost automating what a human trader would have done, between a sell side and buy side. And that's a direction natural language processing is taking. I think we are just maybe 1 or 2 years away from achieving that, if not yet done.
Actually, in between, you made a reference to March 2020 markets. Did Quant strategies fail in 2020 when the pandemic hit first?
Yeah. So there are two different themes of Quant strategies, because see, like I said, Quant has many models. For example, we ourselves have where we follow two different models. So we run a founders fund, a Kristal founders fund on a platform, which is actually having risk parity inbuilt into it for asset allocation. But what March 2020 did was that, because risk parity itself kind of breaks as correlations become one across the board, so you have a tail risk hedge embedded in. So we adopted the tail risk hedging or black swan hedging into the founders fund that we run. But if you go by a standard risk parity model or any asset allocation model, or even a simple mean variance optimization, like a 60-40 portfolio. So those kind of things, go bad when bonds itself start going down with 40% in a day or 20% in a day. You had ETFs, bond ETFs, the most liquid bond ETFs, crashing 10 to 15% in a span of a week, which you've never seen, and you don't even budget for that, in your models. So that's when you realize that, okay, models can break, and any correlations can break. And when liquidity dries up, everything is up for grabs, and you don't know how things will go. And that's when having that extra 10% in the 90-10 formula comes to play. That, hey, yes, I'm following the model, but I know it can break one in, let's say, 10 years. So I'm going to build in for certain hedges, certain events which you can foresee. Now, of course, if you don't do that, then you could have a catastrophe once in 10 years. And hopefully, such events are less frequent. But the way machines are kind of taking over trading, they're a lot more exaggerated. You've seen treasuries move 30-40 basis points in a day. You've seen currencies move 10-20% in a day. And that's the kind of thing which machines exacerbate the move, because all of them kind of think very similarly. It's very momentum driven, and they just go and hit the market, and liquidity kind of rise up, making a problem over there. So yes, models do break, which is where having an oversight on them and tweaking them and making sure there is relearning, it's very, very important whenever you go into a model driven.
So continuing with the same theme, the unidirectional markets, that is one complaint that comes about nowadays, actually. just because the machines are trading, actually, it is a unidirectional market, and then secular theme is being played out. And then, of course, both the extremes are touched, and then the market reverts back to median level at a point of time. Is it something which we should live with, the less volatility and then range trading?
So I think it's more about how momentum plays out. So most of the momentum models are where you start having these unidirectional moves, and it's seen a lot more in stocks than any other asset class, where there is a buying element coming in, and most models start getting signals to buy, and it starts going into some kind of a secular run till something gives in, and some models start tweaking their call on that. I don't think we have a choice of how we can control the market. Market is always right, and at any point in time, it's always right. But in the long run, it's always wrong, or whichever you want to call it, because it keeps changing every instant. But at the end of the day, market is the king, right? And you need to go by that, and it's all the combined effort of the or rather combined flow of the market participants that drives it. So I think that is likely to happen and maybe become more exacerbated. I don't think one can really change it in a big way. But yes, if there are controls being built, which now the exchanges are building in, market participants are building in, because you don't want dislocation. The models are not being built to cause dislocation. In fact, they've been built to bring efficiency. But as a result of that, if certain dislocations are coming in, that is something we should not live with. So there have to be some ways of making sure that, so for example, circuit breakers are a simple example of how you have a human intervention, making sure that models don't, make everything go into the ground, right? So that's where the certain rules or certain tweaks need to come in, whether it's from exchanges or associations of banks or regulators. But that's where I think you can build in certain safeguards.
Yeah, beyond trading, we will get into investment, actually. Conventional investment versus algo-driven investments.
So these are very two different. It's the same argument as active versus passive. Conventional being more, let's say, valuation driven and so on. So at every point in time, I think it's always good to have a market with a very diverse mix of participants. Otherwise, you will never, if you don't have value picking, then you cannot really identify the next new opportunities, because some new opportunities can only be done where you find value. At the same time, if you don't have the quant models, then you will not have the mass participation from people who don't have the ability to go and do the fundamental analysis. And the whole concept of whether it's total rules or whether the price being the best information source about a particular instrument or asset, those things have some value in it. So I think having a real good mix, a team of value as well as momentum or growth, having all these, think of these as pillars of building blocks of a market is, and that's where I think investment should definitely be there. The key difference being with an investment, you are looking at a higher horizon for sure, and there is merit in having certain investments passive, and there is merit in going active in certain investments, whether you call it an active passive portfolio, a core satellite portfolio, or whichever way. But there is merit in having both. Even when we recommend asset allocation or even a portfolio to a client, we go with a core satellite approach and saying that if you're buying bonds, if you're buying REITs, you've got to do your fundamental analysis. You're buying it for like 5 years, 10 years. You can't go by 2 days of price movement to decide which bond you want to buy. That doesn't make sense. You're buying it for retirement for your kids. So there you have to go the fundamental or some kind of value way. But when you're buying certain stocks, if you think only value, you will never buy Tesla. You'll never buy Rivian. You'll never buy any growth stock. Now look at Warren Buffett. Warren Buffett bought, I think, even Amazon when it became like $1 trillion. So he's like seen as one of the best value investors, right? But you miss a 0 to a trillion story, and then yes, you take it from 1 trillion to 2 trillion. That's fine, but but you miss out a lot, right? So you need to have both the sources of energy in your quiver?
Okay, almost that is another question. Of course. What are all the products that you can deliver to a predominantly conservative Indian investor?
So we believe, in a lot of diversification, both of geography as well as asset classes. So Kristal in India looks at the global portfolio of a client. So what we have been advocating is that today you're using, Microsoft and Google and Facebook and Zoom and all these kind of and Google and so on, but you're not buying these stocks or these assets. So going into those, so buy what you use is the best motto. In fact, I go with figuring out what my kids are doing these days, where are they spending money, and actually buy those stocks, and it works out quite well. So that's the having a diversification of those. But if you're having a conservative portfolio, let's say you're budgeting for your children's education. Now in 2008, we saw US dollar rupee go from, I think, close to 39 point something to almost 75 plus. Well, clearly doubled in value, right? So people who are keeping, let's say, 1 crore to send the kids to university suddenly found that 1 crore is actually, let's say it was worth whatever, $200,000, $50,000. It's suddenly worth $125,000. So what do? So in some situations, what we recommend is that keep things simple. You're budgeting for, let's say, an education outside India. You have a currency risk. You keep it in US dollars or pounds, whichever way, and build a portfolio, simple 3, 4, 5% combination of bonds, fixed income funds, or REITs, and just accrue those coupons, which can build a portfolio that you can use use for education, but don't take that currency risk. So go by the 80-20 rule. Keep 20% of the portfolio out in global markets. If you look at what Vanguard's founder Jack Bogle advocated, 18 to 20% you should have in global markets, 18 to 20, 80% you should have in your domestic markets. So that's where the 20% needs to go in a different currency, different geography, and that you can diversify based on your risk profile. And there are a lot of opportunities come, both in equities as well as in bonds, or even in real estate or REITs markets, where you can play around the currencies, you can play around the different asset classes. You'll be surprised. I bought a property in 2008. I used to live in Hong Kong, and the reason I bought a property at that time in Singapore, I was evaluating Hong Kong, Singapore, and Mumbai. The reason I happened to buy a property in Singapore, guess what? Guess what was the main asset class that led me to buy in Singapore and not in other two countries? You want to take a guess? It was not property prices.
Yeah.
It was the forex rate. The forex. Yeah, I was saying. It was the forex rate. I was like, oh my God, this is a no-brainer. That US dollar Hong Kong is there, which is a peg, dollar sitting here, and rupee over there. And this is a no-brainer. This is a value play, and it turned out quite well. And so I'm saying, and no one thinks of currency when they're buying property. Never. Right? But it's so important to do that. Our currency, interest rates, as they come to play, and becomes like a fantastic opportunity. So anyway, what we say is that we go global, start owning some of these high growth names in stocks as well as an income portfolio, and now you are a global citizen. So it's time for you to own the world, right? Gone are those days where Indians used to think like inside the box and in a hole. No, now it's time for Indians to own the world. So go and own the world. Diversify your currency, diversify your asset base. You should own Tesla, you should own Rivian, you should own Apple and Google, whatever it is, right? So just go and build a portfolio or bonds, and find the best opportunity, which is coming from wherever it is coming.
Thank you, Asheesh. It has been wonderful talking to you. The key takeaway is go and own your world. Actually, absolutely fantastic. Actually, on behalf of the audience and on behalf of Almas, I thank you very much for having spent time with us. Thank you very much. See you next time.
Thank you. Thanks for us. It's a pleasure being here. Great having a chat with you. Thank you.